when news broke that former President Trump had announced the firing of Federal Reserve Governor Lisa Cook, the stock market didn't just blink, it jolted. Investors across the board reacted almost instantaneously, sending indices on a roller coaster ride that perfectly illustrated how intertwined politics and finance have become. In today's markets, nothing exists in isolation. Every tweet, statement, or policy change from a major political figure can trigger a chain reaction. And this was a textbook example. Traders and investors, from Wall Street veterans to individual retail participants, suddenly had to rethink their strategies as uncertainty gripped the financial landscape. The first reaction was immediate volatility. Within minutes, major indices like the S&P 500, Dow Jones, and Nasdaq experienced rapid swings, reaching multiple percentage points in either direction. This kind of sharp movement isn't just numbers on a screen. It reflects a deep-seated anxiety in the market about what comes next. For professional traders, these swings represented both risk and opportunity. But for the average investor, it was a stark reminder of how sensitive the market can be to political moves. Volatility spikes like this are often accompanied by higher trading volumes, a sign that everyone, from hedge funds to individual investors, is trying to recalibrate their positions in real time. At the same time, investor sentiment shifted noticeably. Risk appetite contracted almost immediately. Tech stocks, which often lead in growth potential but carry higher risk, experienced more pronounced declines, while safe haven assets like gold, U.S. Treasury bonds, and dividend-paying equities saw increased demand. This is a classic flight to safety scenario where uncertainty drives investors toward assets perceived as stable. Behavioral finance studies show that in times of political upheaval, investors tend to prioritize preservation of capital over chasing returns, and the events surrounding Lisa Cook's firing were no exception. Market indicators, including the VIX, the so-called fear index, spiked, reflecting collective nervousness. Beyond the immediate reactions, the announcement sparked a broader conversation about the independence of the Federal Reserve and the potential implications for monetary policy. Historically, the Fed has operated with a degree of insulation from direct political pressures, tasked with maintaining stability in inflation, employment, and interest rates. When a high-profile firing occurs, questions arise about whether future policy decisions, like adjusting interest rates or controlling inflation, might be influenced by political agendas. For long-term investors, this uncertainty can complicate planning, investment, as the usual signals from the Fed that guide everything from mortgage rates to corporate borrowing costs may become less predictable. After the initial shock, markets began to stabilize, but the trading landscape remained charged with speculation. Investment analysts and investors alike tried to anticipate who might replace Lisa Cook, what their policy priorities might be, and how that could affect both short-term trading and long-term economic trends. For day traders, the situation presented rapid-fire opportunities to capitalize on market swings. For institutional investors and those with retirement portfolios, it was a time for cautious evaluation, balancing the potential for gains with the underlying risk of political influence on monetary policy. In the end, this event wasn't just about one firing. It was a vivid reminder that markets react instantly to news, and understanding the interplay between politics, policy, investment, and investor psychology is crucial for anyone seeking to navigate financial markets effectively. The first and most immediate reaction to the news that Trump had fired Federal Reserve Governor Lisa Cook was extreme market volatility. And this kind of movement is precisely what investors fear and in some cases thrive on. Volatility in financial markets refers to the speed and magnitude of price changes, investment, and it is often the clearest reflection of uncertainty and fear among investors. When a central bank official is abruptly removed, it signals to the market that the stability of monetary policy could be at risk. For traders, this is not an abstract concern. It directly affects the value of assets they hold or intend to purchase. Indices like the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite reacted almost instantly. Within minutes of the announcement, some indices swung by multiple percentage points, demonstrating the sensitivity of markets to political events. These fluctuations are not merely numbers on a screen. Investment. They are the financial embodiment of investor sentiment shifting under pressure. In moments like these, trading volume often spikes, and that's exactly what happened. When the market reacts to news, there's a rush to either offload positions that could lose value or to enter positions that might benefit from the sudden instability. For example, day traders and institutional investors often deploy algorithms designed to capitalize on rapid movements, executing thousands of trades in mere seconds. While this might seem like chaos from the outside for experienced traders, these conditions can present lucrative opportunities. However, for retail investors who are less experienced, the sudden swings can trigger panic selling or impulsive buying, which rarely leads to optimal outcomes. In investment, the intensity of the market's reaction reflected the sheer uncertainty surrounding the political decision and its potential consequences on monetary policy, interest rates, and future economic conditions. Investment. It's also important to consider that volatility is not uniform across all sectors. In this scenario, technology and growth stocks, which typically carry higher risk and are more sensitive to changes in interest rates and economic sentiment, investment experienced more pronounced declines. Meanwhile, sectors perceived as safer or more defensive, such as utilities, consumer staples, and certain industrials, either held steady or even gained slightly as investors sought stability. This sector-specific movement underscores a key lesson for anyone participating in the market's volatility is not just about the overall indices, but also about relative performance between different types of assets. A sharp move in one area of the market can be balanced by stability or growth in another, giving diversified investors some protection against broad losses during periods of political uncertainty. The psychological aspect of this volatility cannot be overstated. Behavioral finance studies consistently show that uncertainty drives emotional responses in investors, often leading to herd behavior. When a high-profile firing like that of a Federal Reserve governor occurs, many investors simultaneously reassess their positions, fearing that what they once considered a stable investment might now carry unseen risks. This collective reaction amplifies the volatility, creating a feedback loop. The more prices move, the more investors react, and the more the market swings. In essence, volatility is as much about psychology as it is about economics. Investors are constantly trying to interpret signals, and a sudden political move is one of the most powerful signals imaginable. Another important factor is the speed at which information travels today. Unlike decades ago, news about political decisions spreads instantaneously through digital platforms, social media, and financial news networks. Investors around the world receive the same information almost simultaneously, which can intensify the market's reaction. High-frequency trading algorithms further accelerate this process, executing trades in milliseconds based on breaking news. This explains why the market reacted within minutes rather than hours. The digital infrastructure of modern finance ensures that information triggers immediate action, making volatility more extreme and more rapid than in the past. Finally, volatility caused by such events is often a short-term phenomenon, but its effects can linger. In the immediate aftermath, investors may pause new investments, adopt a risk-off approach, and wait for clarity on the political situation. Investment. This cautious behavior can influence not just the stock market, but other financial instruments like bonds, commodities, and currencies. The firing of a Federal Reserve governor is more than just a headline. It is a signal that reverberates across the financial system, reminding everyone that markets are not isolated from politics, and that even a single announcement can set off a chain reaction of decisions, reactions, and strategies. In summary, the initial market reaction to Trump's announcement was a textbook case of volatility triggered by political uncertainty. Rapid index swings, high trading volumes, sector-specific movements, emotional investor responses, and instantaneous dissemination of news all combined to create a dramatic financial response. This event serves as a powerful example of how closely intertwined markets and politics are, highlighting the need for investors to remain aware, prepared, investment, and rational even when headlines are shocking. The second critical reaction to Trump's announcement of firing Federal Reserve Governor Lisa Cook was the immediate shift in investor sentiment and a noticeable change in risk appetite across markets. When uncertainty enters the financial system, it doesn't just affect prices. It reshapes behavior, influencing what investors buy, sell, or hold. In this scenario, the firing of a key Federal Reserve official created widespread nervousness, prompting market participants to reevaluate both their short-term strategies and long-term holdings. Investor sentiment is a powerful driver in financial markets, and when a major political intervention in central banking occurs, sentiment often swings dramatically from confidence to caution almost overnight. Immediately following the news, risk appetite contracted noticeably. Traders and portfolio managers moved away from high-risk assets, particularly technology stocks, speculative growth companies, and volatile sectors that rely heavily on investor optimism for valuation. These are the kinds of assets that tend to perform well in a stable economic environment, but are highly sensitive to changes in interest rates, or monetary policy, or political uncertainty. When investors sense potential instability at the Federal Reserve, many chose to risk their portfolios by reallocating capital into safer alternatives. This kind of flight to safety behavior is a classic response during times of political upheaval and market uncertainty. Safe haven assets, including gold, U.S. Treasury bonds, and dividend-paying stocks, saw increased demand as investors sought stability. Gold, in particular, often serves as a hedge against both inflation and political uncertainty, so it became an immediate beneficiary of the market's collective caution. Similarly, U.S. Treasury bonds, which are backed by the full faith and credit of the federal government, are considered virtually risk-free and gained attention from investors looking to preserve capital. Even certain dividend-paying stocks, and especially in sectors like utilities and consumer staples, experienced relative stability as investors prioritize steady income over aggressive growth potential. This reallocation reflects a broader psychological trend in finance. When the future feels uncertain, investors gravitate toward assets that offer predictability and security, even if the potential returns are lower. The market's shift in sentiment was not just about reallocating capital. It also reflected deeper concerns about how monetary policy might change under political pressure. The Federal Reserve plays a central role in controlling interest rates, managing inflation, and guiding economic growth. When a governor is abruptly fired, investors begin to question the independence of the Fed and whether future decisions will prioritize political objectives over economic stability. This uncertainty influences trading behavior, as investors attempt to anticipate the impact of potential policy changes on different asset classes. For example, higher interest rates can negatively affect growth stocks while benefiting financial institutions, while a more accommodative policy might have the opposite effect. These considerations drive portfolio adjustments and explain why sentiment shifted so quickly after the announcement. Behavioral psychology also plays a key role in how sentiment evolves during market shocks. When investors perceive heightened risk, emotions like fear, anxiety, and uncertainty can dominate rational decision-making. Herd behavior often emerges, where individuals mimic the actions of larger institutional investors or follow market trends without fully analyzing the underlying fundamentals. In this situation, as soon as news of Lisa Cook's firing circulated, the initial sell often riskier assets triggered further selling, amplifying the effect. Conversely, the demand for safer assets created a positive feedback loop in those areas, driving up prices. The interplay between fear, optimism, investment, and perceived security shapes market movements in ways that often go beyond traditional economic analysis. In addition, sentiment indicators and metrics, such as the VX, often called the fear index, spiked during this period. These indicators quantify investor expectations of volatility over the coming weeks, effectively translating collective emotions into measurable data. A rising VIX is a clear signal that the market anticipates turbulence, while declines suggest growing confidence. For market participants, these indicators provide an essential guide for adjusting positions, whether by hedging risk, reducing leverage, or shifting towards safer assets. The sudden spike following the announcement illustrated just how much sentiment can influence short-term trading behavior, even before any concrete policy changes occur. Finally, the changes in risk appetite also revealed generational and strategic differences among investors. Long-term investors and institutions often use the volatility as an opportunity to rebalance portfolios strategically, maintaining focus on diversification and long-term growth. On the other hand, short-term traders capitalized on rapid price movements to profit from swings, while retail investors frequently reacted emotionally, sometimes exacerbating volatility through impulsive decisions. The divergence in behavior underscores how sentiment influences not just the market as a whole, but individual approaches to investing, highlighting the importance of discipline and perspective in navigating uncertain periods. In summary, the market's reaction to Lisa Cook's firing was as much psychological as it was financial. Investor sentiment shifted quickly, risk appetite contracted, and safe haven assets gained prominence. The interplay between fear, uncertainty, and strategic behavior drove immediate adjustments in portfolios, while also raising questions about the independence of the Federal Reserve and the future of monetary policy. This episode serves as a clear example of how investor psychology shapes financial markets, particularly during politically charged events, and reinforces the idea that understanding sentiment is as crucial as analyzing fundamentals when navigating complex market conditions. The third key aspect of the market reaction to Trump's announcement of firing Federal Reserve Governor Lisa Cook revolves around the long-term implications for monetary policy and the broader economic landscape. When a Federal Reserve governor is removed abruptly, it raises significant concerns about the independence of the institution, and this is not a trivial matter. And the Fed's credibility is built on the principle that monetary policy decisions, interest rates, inflation management, and economic growth interventions should be based on data, research, and economic conditions rather than political pressures. Any action that calls that independence into question introduces uncertainty, not just in the short term, but for the entire horizon of market and economic planning. Investors immediately began speculating about the potential shifts in monetary policy. The firing signaled that political considerations could influence decisions that are usually insulated from daily political events. For decades, markets have treated the Federal Reserve as a stabilizing anchor, interpreting its communications, policy decisions, and forecasts as reliable signals for managing risk. When that perceived neutrality is disrupted, traders and investors must adjust their expectations. For example, if the market anticipates that interest rate decisions could be swayed by political objectives rather than economic fundamentals, it creates a new layer of uncertainty. investors are forced to price in the possibility of more erratic policy swings, and that uncertainty tends to increase market volatility over a longer horizon. Long-term investors, including institutional players and retirement funds, had to consider how this could affect portfolios that rely heavily on stability in interest rates and inflation projections. Bond yields, for instance, are directly influenced by expectations of Federal Reserve policy. If investors believe that political influence could lead to an inconsistent approach to rate hikes or cuts, they demand higher yields to compensate for the perceived risk. That, in turn, can affect borrowing costs for corporations and consumers, potentially slowing economic growth. Similarly, stock valuations often depend on discounted cash flow models, which assume a relatively predictable rate environment. Even a small increase in perceived risk can lead to recalibration of those models, affecting asset prices over months and even years. Another dimension of the long-term impact is how the market interprets this event in the context of inflation management. The Federal Reserve's dual mandate is to maintain price stability while promoting maximum employment. If investors suspect that the firing of a governor could undermine the Fed's ability to independently manage inflation, inflation expectations may begin to shift. This could prompt adjustments in everything from commodity prices to consumer behavior. Higher expected inflation often leads investors to move into assets that can hedge against it, such as precious metals, real estate, or treasury inflation, protected securities, EBIs. Even small changes in inflation expectations can ripple through financial markets, influencing investment strategies across multiple asset classes. The political signal embedded in this action also triggered debates among analysts and economists about the potential consequences for future Federal Reserve appointments. Market participants began speculating on who might replace Lisa Cook, investment, what their policy priorities might be, and how those priorities could affect interest rates, quantitative easing programs, and other critical financial mechanisms. The speculation alone fueled trading activity and created additional uncertainty. For long-term investors, this is not just noise. It can influence major allocation decisions, particularly in sectors that are sensitive to interest rate changes, such as real estate, technology, and financial services. Confidence in the central bank is critical for the stability of the entire financial system. When that confidence is questioned, even temporarily, it can have cascading effects. Investor behavior is influenced not only by economic fundamentals, but also by expectations of institutional reliability. If markets perceive that the Fed's actions are subject to political interference, there is a risk that the anchor effect of central bank guidance is weakened. This can lead to higher market volatility, more conservative lending behavior from banks, and in changes in consumer spending patterns, all of which influence economic growth over time. It is also worth noting that long-term implications extend to global markets. The Federal Reserve's decisions affect not just U.S. markets, but international capital flows, exchange rates, and investment strategies. Abrupt political interventions create uncertainty for foreign investors and central banks, potentially influencing global financial stability. The ripple effects of a single political move, therefore, are magnified far beyond U.S. borders, highlighting the interconnectedness of modern finance. In summary, the firing of a Federal Reserve governor is not merely a headline event. It has profound long-term implications. It raises questions about the independence of the Fed, affects expectations about interest rates and inflation, and introduces a new layer of uncertainty into both domestic and global financial markets. Long-term investors must account for these risks, recalibrate expectations, investment, and consider the broader consequences for portfolio allocation and economic stability. Ultimately, this event serves as a reminder that monetary policy is not only about numbers and models. It is deeply tied to the credibility and perceived independence of the institutions that manage it. And any disruption can have lasting effects on investor confidence and market behavior. The final aspect to examine in the aftermath of Trump's announcement that he fired Federal Reserve Governor Lisa Cook is the market's recovery and the role of speculation in shaping investor behavior. After the initial shock and extreme volatility, markets began to stabilize, but this stabilization was not a return to calm so much as a period of reassessment. Investors, both institutional and individual, had to evaluate the real implications of the news, separate fact from speculation, and adjust their strategies accordingly. Understanding this phase is crucial because it illustrates how markets process uncertainty over time, investment, and how investor psychology interacts with economic fundamentals to determine short and medium-term outcomes. Immediately following the initial sell-off in riskier assets, traders and analysts began to ask critical questions. How much of this event would truly impact monetary policy? Would there be a replacement for Lisa Cook who would continue existing policies? Or would a shift in Fed priorities occur? These questions triggered waves of speculation as market participants attempted to anticipate the next steps. Speculation is a natural response in markets. It drives trading volume, generates price swings, and can even create opportunities for profit, but it also introduces additional uncertainty. For example, as rumors circulated about potential successors to the Fed governor, investors tried to price in the likelihood of different candidates and their policy preferences, which influenced equity, bond, and commodity markets in subtle but significant ways. During this recovery phase, markets also exhibited signs of selective stabilization. While some indices rebounded quickly, reflecting confidence that the Fed's operational independence would remain largely intact, individual sectors behaved differently based on perceived exposure to policy shifts. Technology and growth-oriented sectors remained cautious, while defensive sectors like utilities, consumer staples, and healthcare regained some stability as investors shifted capital to areas deemed safer in uncertain times. This divergence highlights a critical point: market recovery is rarely uniform. It often reflects nuanced assessments of risk, sector-specific vulnerabilities, and broader macroeconomic expectations. An important factor in this stabilization is the role of institutional investors and market makers. Large players, such as mutual funds, hedge funds, and pension funds, tend to have longer-term perspectives and access to more sophisticated information than retail investors. After the initial shock, these institutions often step in to provide liquidity, buying assets that were temporarily oversold and helping restore order in markets. This activity can smooth out extreme volatility, prevent panic-driven spirals, and signal to other investors that the system is stabilizing. Their decisions, however, are still influenced by speculation about future Fed policies and potential political interventions, which means that while they can mitigate immediate volatility, the market remains sensitive to ongoing developments. Speculation during this period also extended to asset allocation decisions. Investors debated whether to continue holding riskier assets in anticipation of a market rebound or to remain in safer investments until political uncertainty diminished. This balancing act often generates heightened trading activity and moderate volatility, even as headline indices stabilize. In many ways, the recovery phase is a test of investor discipline. Those who can separate short-term noise from long-term fundamentals are better positioned to navigate market fluctuations successfully, while those who react impulsively may lock in losses or miss potential gains. Behavioral psychology plays a significant role in this post-shock period. Investors are not simply responding to facts, they are reacting to expectations, rumors, and perceived probabilities. Confirmation bias, overreaction to news, investment, and herd mentality all influence how quickly markets recover and which assets regain momentum. For example, if early buyers in certain sectors appear confident, others may follow, amplifying the recovery in those areas even if fundamentals remain unchanged. Conversely, if uncertainty persists regarding Fed independence, some investors may remain on the sidelines, limiting the pace of market normalization. Global implications also contribute to the dynamics of recovery. The Federal Reserve's decisions are closely watched by international investors, central banks, and currency markets. Speculation about the Fed's future policies affects capital flows across borders, influencing exchange rates, commodity prices, and global equity markets. Even as U.S. markets stabilize, and these external factors create additional layers of complexity as investors must account not only for domestic policy but also for global reactions and potential feedback loops. Finally, the recovery and speculative phase demonstrate the dual nature of markets. They are simultaneously rational and emotional. On one hand, investors analyze data, economic indicators, and policy statements to guide decisions. On the other hand, emotions, rumors, and expectations about human behavior shape short-term price movements. The firing of Lisa Cook illustrated this duality perfectly. While markets eventually found a footing after the initial shock, and the ongoing speculation about policy, leadership, and political influence ensured that investors remained engaged, cautious, and adaptive. This period highlights the importance of vigilance, flexibility, and strategic thinking in navigating financial markets, particularly when politically charged events introduce uncertainty into the system. In summary, the market's recovery after the announcement was characterized by a careful reassessment of risk, heavy reliance on speculation, and sector-specific stabilization. Institutional investors played a critical role in restoring liquidity, while traders and analysts debated potential policy implications. Behavioral factors, global considerations, and continued uncertainty ensured that recovery was measured, complex, and dynamic. Ultimately, this episode underscores that market recovery is rarely immediate or uniform. It is a process shaped by rational analysis, speculation, and the psychological responses of participants navigating uncharted territory.